Have you ever wished you could just look at a business and instantly know what's going on inside? Well, today we're going to crack that code. We are breaking down the 5 fundamental accounts that tell the entire story of any business.
Seriously? What if I told you there's a secret language that every single business speaks? I don't care if it's a tiny coffee shop or a massive tech company. They all use it. And it's not some complicated jargon. It's the story they tell with their numbers. And today, I'm going to teach you the alphabet. And get this whole language, it's really just built on 5 key terms. That's it, 5 building blocks. Once you get these down, you'll be able to read the financial story of pretty much any company out there.
Okay, first up, assets. This one's pretty simple. Assets are all the valuable things a business owns, all the good stuff.
Now, the official kind of nerdy definition is anything with future economic benefit. But all that really means is that it's something valuable that can help the business make money either right now or down the road.
So what are we talking about here? Well, there's the obvious stuff, right? Like cash in the register, money in the bank, or the products you have on your shelves, that's your inventory. But it also includes the big ticket items like equipment or even buildings. And here's a super important one. It even includes money that your customers owe you. That's called accounts receivable, and it's a huge asset.
Let's make this super real for a second. Imagine you're starting your own shop. You put $5,000 of your own cash into it, and you buy a computer for $1,000. Boom. Just like that, your shop has $6,000 in assets. It's the stuff you own.
All right, let's move on to building block number 2. If assets are what you own, then liabilities are kind of the exact opposite. They're what you owe. The fancy term is a future obligation, but really it's just a promise to pay someone back. It's a debt. It's someone else's claim on your stuff.
And we're not just talking about bank loans here. Liabilities also include money you owe to your suppliers. That's called accounts payable. It also includes any salaries you owe your employees, and of course, any taxes you'll have to pay.
Okay, let's jump back to your new shop. You've got $6,000 in assets, which is great. But let's say to get started, you had to take out a $2,000 loan from the bank. Well, that $2,000 loan, that's your liability. It's not really your money, because you got to pay it back eventually.
So we've got what you own, your assets, and we've got what you owe, your liabilities. So what's left? Well, that brings us to our third and maybe most important concept, equity. Think of it as your actual stake in the business, your slice of the pie.
Equity is what the owner truly has a claim to. Here's a way to think about it. If you sold off all your assets today for cash, and then you use that cash to pay back every single one of your liabilities, whatever's left over, that is your equity. It's the real value of your ownership.
And this brings us to like the first major aha moment in all of accounting. It's this beautiful, simple little formula. Equity equals your assets minus your liabilities. What you own minus what you owe. That's it. So let's do the math for your shop. You've got $6,000 in assets, that's your cash and the computer, and you have a $2,000 liability, that loan from the bank. So your equity, your actual personal stake in this whole thing, is $4,000. That is your piece of the pie. Okay, so those first 3, assets, liabilities, and equity, they give us a snapshot, right? A picture of the business at a single moment in time. But businesses aren't still pictures, are they? No way. They're a movie. And that's where our last 2 accounts come into play. Revenue and expenses.
This one's really straightforward. Revenue is all the money coming in from your sales. You sell something for $500, that's revenue. Expenses are the costs of actually running the business. You pay $200 for rent, that's an expense. One is money coming in, the other is money going out to make it happen. And here is the absolute key. This is how it all connects. Every single dollar of revenue you earn increases your equity. It makes your slice of the pie bigger. And, you guessed it, every dollar you spend on an expense decreases your equity. It makes your slice just a little bit smaller. Revenue and expenses are the engine that drives the value of your business up or down. And now we get to put it all together into what is basically the golden rule of accounting. It's this one perfect equation. Assets equals liabilities plus equity. All it means is that everything a business owns has to be claimed by someone. Either it's owed to others, like your liabilities, or it belongs to the owner, which is your equity. It always has to balance. But now that we know about revenue and expenses, we can see the full, complete picture. The whole shebang is actually assets equal liabilities plus your starting equity, plus all the revenue you bring in, minus all the expenses that go out. This single equation tells the entire financial story. It's kind of beautiful, right?
Let's watch it work with your shop. Step 1. You put in $5,000 cash, your assets go up, and your equity goes up by the same amount. See? Balanced. Step 2. You get that $2,000 loan. Your cash and asset goes up, but so does your liability. Still balanced. Step 3. You make your first sale for $1,000 cash. Your cash asset goes up, and your revenue makes your equity go up. Perfect balance. And finally, step 4. You pay $300 for rent. Your cash asset goes down, and that expense makes your equity go down. It always stays in balance, every single time.
And there you have it. Assets, liabilities, equity, revenue, and expenses. They aren't just boring terms on a spreadsheet. They're the words and sentences of a financial story. And the cool part is, you now know the language. So go take a look at your own finances. What story are they telling about you?